And that's why we say that even though rates, of course, on, say, credit cards are incredibly expensive, it's no longer 16, 18%. As we talked about, it's 20, 24, 26, 28, 30%, in some cases more. And banks have gotten around some of these old regulations of usury by factoring in default rates and things of this nature. But usury used to be 23.99%. Now in most states, it's 29.99%. You know that some big bank or financial institution paid a lot of money to lobby some, congressional individuals to change that. And now, of course, you can have a default rate. You could be one day late and they can give you a default rate that could be 30, 35% plus. So we think that's the most expensive loan we have, when in reality, in most cases, it's a traditional mortgage. And not just because it's the largest loan, that is typically the case. Not just because it's the longest term, that is also generally the case. But it's because how that loan is specifically designed to calculate the amount of interest you pay on a given payment. So sometimes people say, oh, well, a mortgage is, just a simple interest calculation, no different than a car loan, et cetera. Well, but is that really true? Well, first of all, let's use an example that we talked about, CJ, I think about a month or two ago. And let's say, for argument's sake, you have 4 different loans. Now, it could be a lot more, but let's just say, for argument's sake, it's 4 different loans. Let's say you have a 6% credit card. That would probably be effectively impossible, but let's just say, for argument's sake, you had a 6% credit card. You had a 6% line of credit, whether it was a personal line of credit, a business line of credit, or a home equity line of credit. You could have a 6% car loan and a 6% mortgage. Now, again, on the surface, they all look or appear to be the same, but they only look that way because it all has to do with not just so much interest rate, that's a factor, of course, but it's how the interest is calculated, how the finance charges are assessed, and how and when the payments are applied that actually determines the true debt service cost, or the amount of interest volume you're going to pay per payment, which is ultimately going to factor into what your effective interest rate is. That's the vernacular that matters. How much are you effectively paying? We've heard the expression a lot, effective tax rate, right? So we have a gross tax rate, and then depending on deductions or other factors involved, you have a net effective tax rate. Well, it should be called net effective interest rate as well. So when people tend to misunderstand interest volume, here's a great way to look at it. I encourage everybody that's watching or viewing this particular podcast, take your mortgage statement. Your most recent mortgage statement is fine. Separate escrows, because of course those are independent of the loan. Those are things you have to pay, taxes and insurance or MI, et cetera, predicated on simply just having that home. But take into account your principal and interest payment alone, just the actual portion that applies to the debt or the loan itself, and divide the amount of interest into the entire principal and interest payment. And that's going to give you the amount of actual interest volume. And it's not going to be, even on a 2, 3, 4% loan, it's not going to be 2, 3, 4%. It's probably going to be 40, 50, 60%. And as the rate gets higher, even more. I've seen it where those cases where it's 70, 80, even 90% interest volume. Now that amount goes down over time because that's how the bell curve of these amortization schedules work. However, unfortunately, for 80 or 90% of America, that moves about every 6 to 8 years, or buys another home every 6 to 8 years, or refinances, or I'll add, breaks up or gets divorced every 6 to 8 years. It's called the 7-year itch. It's actually based on biochemistry, believe it or not. And the banks, this was not lost on them. So when they started developing longer term loans many, many years ago, and when you think about even the term mortgage, right? We've talked about this before. It's mort is dead, or it's to put to death. It's a death pledge. It's a pledge for death, which is why it should be called that, because most people have a loan their whole lives, or they refinance it or move. So they don't end up with a 30-year mortgage because they don't live in the same home, in the same neighborhood, and have the same job for 30 years, right? They ended up moving, and all of a sudden they reset that clock over and over and over again. So they end up with 40, 50, 60, longer in some cases, loans or indebtedness over the course of their life. And people began to look at their homes, unfortunately, more like an ATM or as an investment, which it can be in certain circumstances. But to be clear, it's more of a liability when it's not generating income. It doesn't mean it couldn't appreciate, but that still means that without paying money to service that loan out of your pocket, it's not really an asset. So that's just a couple of the basics there, CJ, if that helps. But it also comes down to understanding that, back to our example of the 6% credit card, the 6% line of credit, the 6% car loan, and the 6% mortgage. Let's take a look at that for a moment.